Hello and welcome to our investment quarterly review. Today we're going to do two things. We're going to look at stock market returns for the first quarter of 2023, and we're then going to look at what is known about investing and how that information can be used to construct and to manage your investment portfolio. Well, let's start with the numbers. The Canadian stock market is measured by the S&P TSX index in the first quarter of the year is up just over 4.5%. Now, the US market, as measured by the Russell 3000, that is up just under 7%. And internationally, as measured by the MSCI index, now that includes emerging markets, that market was up, like the United States, just under 7%. So that's the short term. Let's step back and look at what is known about investing. What is the greatest influence on your portfolio? Influence with respect to volatility and ultimately the long-term return? Well, clearly, without any doubt, it's asset allocation. Let me provide an example. Most portfolios are made up of stocks and bonds. Stocks are considered to be more risky. So when the market gets nervous and there's a big decline, stock markets can really plunge in value. But also when things are optimistic, they can go up very quickly. Bonds, on the other hand, you're not going to get a return over time better in bonds than you are in stocks. That's not what's happened for the last 100 years, and presumably that's what's going to happen in the next 100 years. But what the bond does is it gives you stability. That's your ballast. You're not buying a bond for return, you're buying it for stability. And depending on your circumstances, your time frame, your objectives, and all the things about you, that is what is going to determine your allocation between stocks and bonds. Now, the second foundation of investing is diversification. You see, we do not know what the market's going to do next week, next month, even next year. But we do know that diversification is within our control. That is something that we can do, and that's us providing safety to our portfolio. For example, how would you develop a portfolio of stocks? And where would those stocks be purchased? What countries would they be purchased? Well, to look at the entire world and all the publicly traded stocks that you have access to as an investor, 3% of those companies, when measured by the capitalization, by the size of companies, 3% of those stocks are available in Canada. Therefore, we recommend 3% of the stocks within your portfolio be held in Canadian companies. The United States accounts for 60%. We recommend 60% of your stock portfolio be held with American stocks. And finally, 37% would be invested in the balance of the rest of the world, non-North America. So how would we describe the market today? If I had to describe the market, I'd call it, well, pins and needles. It's very anxious. There's a lot of things going on in the world that are unpleasant and that are making investors nervous. We've got the Russian invasion of Ukraine, been going on over a year. Got very high inflation. Central banks in our country and throughout the world have raised interest rates to be very high to try to put the brakes on inflation. And that means with inflation, things costing more, with the cost of borrowing things costing more, some businesses are having trouble making ends meet. So that's the kind of situation we're in now. In the last quarter, there was a really nervous jitter within the banking sector. And Silicon Valley Bank was the second largest bank in American history that went broke, and that just happened. Over in Switzerland, their second largest bank got into trouble and basically went into a tailspin and very quickly was taken over by the largest bank. What we have seen in history, when there's angst, when there's nervousness going on in the market, there is excessive volatility, higher volatility than normal. And while the world is on somewhat pins and needles, there's every reason to think that that volatility might continue. Well, if I had to summarize investing, I'd say it would be best to take a long-term perspective. See, we don't know what's going to happen in the short term, but in the long term, we can be fairly sure that stocks are going to outperform bonds, albeit bonds have provided you the safety of the conservative ballast that you're looking for. So that's how your investments would work. We hope you've enjoyed this investment review. And if you'd like to speak to us further, or if you'd like to sign up for our newsletter in a very few seconds, we're going to show you how that can be done. In the meantime, hopefully you've enjoyed today. Till we meet again.